Hello, this is Books of the Stock Market. How's everyone doing? As for me, I'm doing pretty good. It started snowing again and the roads are back to being a sludge fest. At least the road is not frozen cause surprisingly during the day it's pretty warm. Other than that, I've been working on my new video series. At this moment, I've successfully edited one video and I'm working on the second one. It takes a bit of time stitching the audio and images together, but it's fine. I've been going down the rabbit hole of using Fusion and DaVinci Resolve and it's kind of confusing, but I think I should be able to get used to it pretty soon. With that out of the way, let's talk about today's video. In part 3 of a 3-part series, we will be talking about the MACD, which is our final oscillator. If you haven't watched the other 2 videos, or at least part 1 of the video series, you should probably watch it as I don't really go over the basics of reading an oscillator. I'll link the 2 videos in the comment section below and put part 1 in the I button on the top right corner of your screen. After we go over the MACD, we'll be looking at the psychological theory behind contrarian opinions. Before we get into the MACD, let's go over the idea that we can combine 2 moving averages together to form an oscillator. So in the video where I explained moving averages, we know that 2 moving averages crossing over each other result in a buy or sell signal. Using this, if we can combine the 2 moving averages together, we can form an oscillator that gives out the same signals without looking at 2 lines. For instance, if the shorter moving average is above the longer moving average, then the oscillator combining those 2 moving averages will result in a positive number. On the other hand, if the shorter moving average is below the longer moving average, then the oscillator combining those 2 moving averages will result in a negative number. Now that we know the basics of how an oscillator combining 2 moving averages will work, let's dive into the complexities. When the oscillator becomes too positive or too negative, this means that a consolidation will occur. If you think about what this represents the shorter moving average is really overextended above the longer moving average. This causes the shorter moving average to come back to the longer moving average. From here, there are 2 scenarios that could play out. First, the shorter moving average will bounce off it and continue the current trend. So in an uptrend, the shorter moving average will dip to the longer moving average and then bounce back upwards, continuing the trend. Likewise, the downtrend will have the shorter moving average rise to the longer moving average and then bounce back downwards. The other scenario is that the shorter moving average breaks through the longer moving average and causes a change in the trend. The MACD is an indicator that uses the concept that I just explained. It uses 3 moving averages and shows them as 2 lines. The first line is called the fast line or the MACD line, and this is the difference between 2 exponentially smooth moving averages. The 2 exponential moving averages are the 12 and 26 days or weeks. The second line is called the slow line or the signal line, and this is the 9-period exponential smooth moving average of the fast line. When the faster MACD line moves above the slower signal line, then you buy the asset. If the faster MACD line moves below the slower signal line, then you sell. And as with all indicators, the concepts of being overbought, oversold, and divergences apply. Here we see Bitcoin forming a triangle and is consolidating. I have the MACD shown below. The blue line is the MACD line or the fast line, and the orange line is the slow line or the signal line. Here we see the MACD line cross above the signal line. This shows a spike in price. Also, ever since the crossing, it foretold Bitcoin's upward price action. However, the MACD line crossed below the signal line very recently. This caused a move downwards, and since the MACD line is still under the signal line, this is very worrisome for Bitcoin as we are reaching the end of the symmetrical triangle. This could cause Bitcoin to move downwards as the MACD is showing a sell signal. As with all indicators, the MACD can exist as a histogram. When the MACD line is above the signal line, then the histogram shows a positive value. On the other hand, if the MACD line is below the signal line, then the histogram shows a negative value. With the basics out of the way, let's look at why a person would use a histogram over the original indicator. When breaking this all down, the MACD histogram simply represents the distance between the MACD line and the signal line. This is very useful as it can signal changes in trend. For instance, if the histogram is showing a positive value but it starts to fall toward the midpoint line, then the uptrend is weakening. Essentially, this means that the distance between the MACD line and the signal line is narrowing. Likewise, if a negative value becomes less negative, this means that the downtrend is weakening. A less negative value means that the MACD line is slowly coming closer to the signal line. On the other hand, when the histogram value becomes more positive or negative, then this means that the distance between the MACD line and the signal line is increasing. This increase signifies the current trend is getting stronger. Therefore, the MACD histogram is very good at visualizing the MACD line moving towards or away from the signal line. Here we have the same Bitcoin graph as before, but instead of the normal MACD indicator, we have a MACD histogram. In this area, we see that Bitcoin peaked. Before this peak, we had this area. As you can see, price was increasing, causing the MACD indicator to rise as well. However, once price stopped rising, we got a drop in the MACD. This caused the move towards zero, and it eventually crossed below zero. We're at this point, and we see the MACD is flattening out due to price consolidating in a very tight range. From this, the only conclusion we can make is to wait for the MACD line to cross back above zero, as we don't really know how much lower Bitcoin can go. With our last indicator out of the way, let's talk about the psychological aspects of trading by talking about contrarian opinions. Basically, when the vast majority of traders agree on a direction or on a position, then they're usually wrong. Is there any factual basis around this concept? Well, technically, there is. Analysts believe that when there's more agreement on a direction, then there's less buying or selling pressure to fuel the move. For instance, if everyone is bullish and fully positioned, who will continue to move upwards? Here we see a figure that shows the speculative dollar positioning. Recently we have been making lows on the dollar as the Fed is printing a lot of money. If you want to know more about the current situation around the world, watch my Sunday Report videos where I talk about the financial events of each week. I'll link that playlist in the comment section below, or you can click the I button above. With that shameless plug out of the way, we see that we reached new highs on net short position on the dollar. The contrarian opinion concept would ask us to take a long position as we see the majority of people are bearish on the dollar. Personally, I wouldn't, as the Fed is not going to stop injecting money, and there are probably better trades than this. The contrarian opinion can also be applied to futures. As we learned in a previous video on futures, for every long, there must be a short. This means that if 80% are long, 20% are short. Since 20% are short, this means that they're risking higher capital than the ones who are 80% long, as the dollar amount should be equal between longs and shorts. Therefore, many analysts believe that 20% to have the strong hand, or simply put, less likely to sell their position. The 80% are considered to be weak hands as they're holding smaller positions and are most likely to sell when things get shaky. Moving on, let's talk about how open interest affects the concept of contrarian opinion. So the higher the open interest, the higher the chance the contrarian positions are profitable. This is based on the fact that open interest technically means that more people are agreeing on the same direction of the trade. However, if open interest continues to increase, then don't take the position as it means that the trend is still strong. You must wait for open interest to flatten out as it signifies the trend is weakening. Other psychological-based theories include how the asset reacts to news. If the price doesn't react to bullish news in an overbought territory, this means that the trend is not strong. This means that at this point, the stock can't really go higher, so a drop is coming soon. Likewise, if price doesn't react to bearish news in an oversold area, the trend is weakening. This means that the asset has priced in most of the bad news and is ready to move upwards. To wrap up this video, let's talk about sentiment readings. Sentiment readings are surveys given to analysts, ordinary people, and basically anyone who's involved in the financial markets. They tell you if the different types of people are bearish or bullish. For instance, it tells you if the analyst or smart money is bullish or bearish, and it also tells you if ordinary people or dumb money is bullish or bearish. Here I have 3 popular sentiment reading surveys shown below. Let's look at the AAII indicator. We see that for the week of January 20th, 42.5% are bullish, 23% are neutral, and 34.5% are bearish. We see that we became less bullish overall and a bit more bearish. To be honest, I don't use sentiment-based surveys, but they could probably be useful when people are extremely bullish or bearish, as it can allow you to set up your contrarian opinion trade. Well, that's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of this channel. In this video, I wrapped up oscillators and talked about some trading strategies based on human psychology. The next video will talk about the advanced concepts of candlesticks. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all of the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.